Welcome to another episode of Beyond the Numbers. And where before we were a podcast, we are still a podcast, but this time we are now also a vlogcast for our new season. So we are into video as well, which is wonderful. And on this occasion, we're focusing on the upcoming budget 2021 next month, and what does the Chancellor Rishi Sunak, what is he cooking up? And to give me a bit of thought on this and analysis, or potential analysis, is our very own, one of our very own tax specialists, Tom Biggs. Hello, Tom. How are you doing?
Yes, yeah, good. Thanks, Chris. Yeah, you all right?
Yeah, not bad. Great to see you, albeit digitally in these strange lockdown times, lockdown 3.0.
A little bit strange, isn't it? But
yeah, indeed. I use the word tax specialist, Tom, because not expert, because not that I'm doubting your knowledge or credibility. Far, far from it. I know how skilled you are, but I just find that expert is such a dangerous term, and what makes someone an expert? Very dangerous.
Expert sort of sets you up for fall, doesn't it? I feel like
potentially, and you know, who decides what makes you an expert? So I think you're an expert, but I prefer to use the term tax specialist. So being on the subject of tax, Tom, and what tax changes might be coming, I thought I'd start with what do you think is the biggest outgoing in your lifetime, the single biggest outgoing item of expenditure in your world, Tom?
Gut instinct would say it's got to be your house, isn't it? I would have thought.
Yeah, your house or your mortgage.
But yeah, I get that, yeah.
That's what most people would answer, and in some ways, you know, I get that. It's actually the second one. The biggest outgoing in your lifetime is your government, Tom. That's correct. Tax.
Okay, yeah,
and the tax you pay to your government.
Yeah.
I mean, the government is the single biggest item of expenditure in your lifetime. And it's always good to sort of recall why we pay tax and what it's for. And that's for all sorts of public services, including health and defense.
Yeah.
And so given the COVID-19 pandemic, there's had to be a huge amount of expenditure around those two items. I believe the UK is one of the nations, I think it's like per head, that has the biggest expenditure, COVID expenditure per head on COVID-related defense.
Right, yeah.
And you could debate all day long how well that's gone in terms of the economy and the human factor. But if we look at things from a broad perspective to start with, basically Sunak faces a bit of a Rishi Sunak, Dishy Rishi, as he was known last summer. He faces a bit of a dilemma. The budget deficit, i.e. what we spend versus what we take in tax as a country, that now stands at 271 billion. So there's a gap of 271 billion. And apparently that is up 212 billion on last year. So these are eye-watering sums. And of that, 86 billion to December 2020 went on COVID support schemes. So already we're in February, it'll be even more than that. And that deficit, the annual overspend, will be getting bigger because of we're in another lockdown, more support, etc., etc. And what this means is if you look at the UK's total debt pile, well, that now stands at 2.1 trillion. 2.1 trillion. I can't even imagine.
It's
unthinkable. It's unthinkable. The one sort of little bit of maybe good news is that the interest on our debt is 20 billion. That is a lot of money. Okay, so every year, you know, when we do the budget and all these things, 20 billion has to be set aside as expenditure, or of the expenditure is set aside for paying the interest on our national debt.
Yeah.
So 20 billion is a lot, but I think compared to what it was previously, that's not too bad. And I think primarily that's down to the fact that interest rates are around the world incredibly low. Otherwise, it would be a lot higher. So that's a bit of good news, but it comes with a warning that rates won't stay low forever.
I was going to say that. I think a lot of the stuff I've read recently sort of suggests that the rates being low like they are is probably going to stay the same because there's no incentive for the government to put it up, basically, is it? Because given the amount of debt.
Yeah, I mean, longer term, there's the concern that with sort of supply chains smashed, if you like, because of COVID, and when we all finally emerge from these restrictions or peel them back, if you like, slowly, there could be an unleashing of quite a lot of demand, because a lot of people, whilst there's a lot of unemployment, plenty of people have stayed at home, saved a lot of money, not gone out, not traveling. So there might be a surge in demand, not enough supply, and that might put the price of things up. And of course, if you get inflation, then interest rates may have to rise. So yeah, I think, as you say, it doesn't look like it's going to change anytime soon, but a little bit further ahead, that there may be some warnings.
Yeah.
So it leaves Dishy Rishi, with effectively what looks like two options. Either he cuts spending, right?
Yeah.
Or he raises taxes. And I think we can agree, Tom, that he's very unlikely to cut spending.
I think it's difficult politically, isn't it, at the moment, given what sort of happened in the sort of previous governments, isn't it? Really, it wasn't met with an awful lot of applause, was it?
Yeah, exactly. And we already had a sort of decade of a form of austerity. Is it politically going to wash down with the electorate to have another potential decade of austerity? I think politically that's probably committing suicide for the Conservative Party, without going too much into politics. So he looks like he's very unlikely to do that. Okay. And that means that his next option is raising taxes. Oh my goodness. How did we get here? So before I go into what that's going to potentially look like with you, if you recall, before December, there was the huge, 3-4 year debate around Brexit, getting it done, all that stuff. And one of the sort of visions of many a Conservative MP was that, get Brexit done and create a low tax post-Brexit Britain akin to Singapore.
Yeah.
COVID happened, and that looks like that ambition is straight out the window. So be some very happy backbench MPs about that.
Yeah.
Looks like taxes, and then this creates two dilemmas for Rishi, because he seems to be hell bent on this. Fleet Street is awash. The financial pages of Fleet Street are awash with, what might he raise and why? Okay. Yeah. But he's got a problem, because he's a bit limited by what he can raise, because the election pledge of the Conservative Party was no increases to income tax, national insurance, or VAT.
Yeah.
So this is where you come in, Tom. You're Rishi Sunak. Over to you. What are you going to do?
It's a tricky one, this, isn't it, really? Because whilst obviously, as you've mentioned there, Chris, we've got this massive deficit. We're still in a time where, because of lockdown and everything, it's a lot to ask of people, isn't it, to start banging up taxes? Especially for, one of the points we're going to talk about is corporation tax briefly, but a lot of business has been decimated from lockdowns. We've sort of seen it in the news recently, and we with sort of Debenhams and those kind of guys at that high level, but even down at the level of sort of some of our clients, our sort of SME sort of companies, they've had to shut up shop and haven't been able to.
It's tragic. It's tragic, isn't it? It's people's lives. Their purpose, even. Their purpose in life was their business, making a change to the world.
It's been so difficult. So it is. It's a really delicate balance that Rishi's got to get here, and it's questionably can it be achieved, I guess, because pushing taxes up, you're kind of pushing the burden back on the people that are suffering as a result of what's going on, really. So
okay, well, two things before we start. So personal opinion here is, why would you raise taxes or even consider raising taxes when the economy is semi-closed at the moment, and your timing of your tax rises could coincide with the economy reopening and barely recovering?
Yeah.
And I think another thing to say is that we are, in this post, we are speculating, right? We are speculating. So you should never basically take on any advice unless you get do anything unless you get professional advice. That's basically
it would be nice,
right?
It would be nice if Rishi sort of gave us a call beforehand and let us know what's going on. But and unfortunately,
keep calling Tom. He's just not answering the phone. Damn him.
yeah, he just doesn't return my calls. I don't know what more.
Maybe he just likes WhatsApp or something like that.
Yeah.
Just have to message him.
Yeah, that's it. Yeah. So no, you're right. It is all sort of speculative, isn't it? So,
Yeah.
so I mean, one of the things that have been doing the rounds quite a lot, and there's been quite a lot written about this, is capital gains tax.
Oh yes, yes, Tom.
So I think this is something that Rishi's been quite keen on anyway, as I understand it. I think he commissioned a report to look at it, which the Office of Tax Simplification sort of had a look and produced a report. And from what I read, effectively they came back fully supporting a reform of capital gains tax. So it's difficult to see if Rishi himself is sort of like, keen for the idea, and he's been supported almost by what the OTS have come back and said. It's difficult to see that won't go up at some point. But, really, I think politically it's probably an easy win for it to go up, because it doesn't affect, relative to income tax, it doesn't affect a vast number of people. Yeah. But because of the differences between CGT rates and income tax rates, putting those up, and obviously also factoring in the sort of amount that's involved in a lot of capital gains, it would be a massive tax intake for the government if that went up.
So it will have a big impact on tax revenue for the government.
Yeah, but from stuff I've read, I can't remember off the top of my head the exact figures, but I think it will make a massive difference, just because obviously when you're talking about capital gains, you are talking about typically high value items. So, it could be, I don't know, a second home or shares in a company, whatever it is. Typically, they are high value items that are involved. So,
even high transaction value, basically.
Yeah, exactly. Yeah. So even a sort of slight increase in those rates is going to have a big impact on tax revenue, but that will only affect a relatively small number of people. So it's probably a fairly easy win for him, from a political perspective, I suppose.
I just interrupt you there briefly, Tom, because the other day, obviously we do a little bit of preparation for these things, especially you. I know you're a key man for detail. I then read an FT piece about capital gains tax, where apparently there was an unnamed quote from the Treasury said, "Oh, that OTS report, yes, they're just a bunch of bureaucrats, pen pushers,
right,
and idealists." And that doesn't mean to say that we're taking the CGT recommendations seriously.
Is that right? Yeah.
It's typical, isn't it, with the government? They get a body to, go out and make recommendations, and it's all smoke and mirrors.
Yeah. It's a difficult one, isn't it? Because I think, again, some of the stuff I've read I think it might have even come out of that report, was sort of kind of suggesting that people are sort of organising their affairs to effectively turn what would otherwise be income into capital, and therefore pay the lower rates. I think is the main driving force behind this. So for example, you might sort of realise a gain on some shares that would otherwise, it would have generated you an income, and as a result, you pay a lower rate of tax. So I think that's kind of the main driving force from what I've read, which I guess would then tie into why the talk is of aligning capital gains tax with income tax. So then you kind of you remove that sort of incentive, I suppose, to kind of organise your affairs in such a way to move stuff that would be income otherwise to capital.
There's an element of sort of marshalling tax avoidance to it.
Yeah, I guess kind of. Yeah, I mean it's all legitimate.
Feel free to correct me. Obviously,
it's all completely
terminology. But,
no. I mean it's what's being done. There's by letter of law, absolutely nothing wrong with organising it in such a way. But I think that the argument from the report is that effectively we've got a loss in tax revenue, if you like, because it would otherwise be taxed as income tax rates. So I think that seems to be the driving force behind it, which is why you'd be looking at, I think, the top rate of capital gains tax, if we take avoiding residential property, is about 20%. Yeah. Well, if you align that with income tax, and someone was let's say an additional rate taxpayer, that would go from 20% to 45%. So we're talking, it is a big increase.
That is significant, isn't it? That is very significant.
Yeah.
Okay, so say he goes ahead with that.
Yeah.
When he introduces, because he might announce at the budget, but then there might be a time frame before he introduces it to give people time for planning.
Yeah.
What sort of things, remembering our disclaimer from earlier, what sort of things should people be thinking about and talking to their advisor or advisors, such as yourself, about?
I mean, the main thing really is going to be about timing of when you realise gains, I suppose. So if you know that you've got you're considering some sort of disposal of a capital asset, there might be a question as to perhaps bringing it forward, or when the timing of that might be. It's going to be the main thing here, really. I mean, there is talk as part of this of reducing the annual allowance. So at the moment, it's around about £12,000 a year. I think it's 12,300 this year, tax free. So there's talk of bringing that down as well. So again, that will potentially have an impact as to when you realise gains, possibly. But again, I mean, it's one of those things really where you kind of need to be talking to your advisor about it, quite frankly. There's so many varying factors with all this, and as we said at the start, it's all speculation. You really need to kind of reach out and speak to your tax advisor to kind of discuss your own personal circumstances, really.
Yeah. Well, on that note, I should say, if you're wondering about capital gains tax and want to know more about it and all the details around it, then be sure to check out the Weller's blog, wellersaccountants.co.uk/blog. And the name of that particular one is "What is Capital Gains Tax in the UK?" And that explains everything. No doubt after the budget, we'll have to update it with the latest figures in the allowance. Who knows? We shall see.
Yeah.
So anything else on CGT, capital gains tax, Tom?
So the final thing that was quite interesting, actually, I was reading, it kind of links into the next point that we'll have a chat about inheritance tax.
Brilliant. Yep.
So one thing that the OTS report suggests should be looked at is removing the CGT uplift on death. So at the moment, where someone has a capital asset that they hold up to the point of death, if there's an underlying gain within that effectively gets wiped clean, for want of a better term, on death. And then whoever inherits the asset would get an uplift in the base cost to the market value at that point. So what the report is talking about is effectively taking that out. So there would presumably then be capital gains tax on death. And I think, from what I understand, the main driver...
CGT on death?
Well, I assume. I mean, from what I've read, I mean, I didn't see the detail of it, but I assume if they're talking about removing it, there would effectively be a capital gains tax on death. Before then, the whoever inherits the asset gets the uplift to that market value, right? And I think the main sort of, I guess, focus with that is that it kind of encourages people to hold on to assets up to the point of death, because then it wipes. Effectively, you wipe away the capital gains tax that's underlying, possibly. But again, politically, then it means that assets aren't being passed down generations when perhaps they might otherwise be, more useful, if you like, if that makes sense. So again, it kind of it strays into inheritance tax a little bit, which we'll talk about in a minute. But it was just that was quite an interesting point I was reading about.
So I guess to finish off, it's this is a tax on wealth, so to speak.
Yeah.
And that may be more politically acceptable because it's seen to be making the rich and wealthy pay, which has been a debate for the last decade.
Years and years. Yeah.
So there's quite a bit of planning around that, quite a bit to think about, and even start considering now.
Yeah, absolutely. Yeah.
Talk to your advisor. Again, the stuff to do with inheritance tax is covered in that CGT blog post I was referring to earlier. Go on, Tom. Next one, IHT, inheritance tax.
Yeah, so IHT is something that there hasn't been an awful lot of change in recent years. For example, the nil rate band, which is effectively a threshold at which you don't pay any inheritance tax on, that's currently 325,000. There's a separate sort of resident nil rate band, but for this purpose, we're just ignoring that for now. So generally, you get 325,000 inheritance tax free. Now that band has been at that level since I think it's 2009. I think it is. So we're now at a point where particularly if you look at property, and again, it's kind of covered by the nil weight, the resident nil weight band bit, but asset prices have kind of gone up massively since then, and yet we're still, the nil weight band's been kept at the same level. So there hasn't been an awful lot of change to inheritance tax. So it was quite.
It hasn't risen with inflation then.
No, yeah. So the nil weight band stayed at the same levels since 2009, albeit there's been this additional one that I think it's George Osborne brought it in to kind of cover off main residences and that sort of thing. But generally, it's been kept at the same level since 2009, the standard nil weight band. So there hasn't been an awful lot of change within IHT over recent years. So again, I think the Office for Tax Simplification sort of had a look at it, and I think in 2019 it was, there was a report that they wrote which effectively said that there's only 25,000 estates in the UK actually pay inheritance tax, but about 10 times that amount actually have to fill in all their IHT forms and whatever has to go to revenue. So there's a lot of sort of pen pushing, for want of a better term, even though there's actually no tax to pay. So I think that what they're suggesting is that he's looking at some way or another, which in some respects, given what I've just said about it not sort of having changed for a long time, might be a bit refreshing actually to see a bit of change in IHT, quite frankly. So some of the changes that they were talking about is a possible review of gifts out of income. So typically where you make a gift to someone out of your income and it doesn't affect your way of living, if you like.
How much can you do for that?
So there's no set amount, as long as there's a sort of a burden of proof to show that your sort of way of living, if you like, hasn't been sort of decreased, if that's the right term, as a result of making the gift. So as long as you can sustain your kind of way of living, there's no limit as to how much you can gift out of income, pretty much. So that kind of then is an additional exemption that is outside of that no weight band I spoke about. So there's talk of sort of reforming that possibly, and I guess potentially removing it. It's it's all sort of speculation a little bit. The annual allowance. So again, there's an annual allowance for inheritance tax in the same way that there is for capital gains tax. That's currently £3,000 a year. What they're possibly looking at doing is increasing that. So there would be a slightly higher amount that you'd be able to give each year and not have to worry about at all. But the sort of offset to that would be that there's currently an exemption on gifts on a wedding, for example, that would then fall within that allowance. So they'd give you more of an allowance on the general annual one, but then they'd take it away somewhere else. That makes sense. So it sounds
gives with one hand and takes away with the other,
exactly.
Right?
Yeah,
Smoke
exactly.
and mirrors. There you go.
So it sounds great, but actually you'd lose something elsewhere.
Of course, probably lose a bit more, right?
Yeah, exactly. Yeah. So there's that, and then an interesting one again that might impact some of our clients is that they're talking about removing business property relief. So again, if you say it subject to certain conditions being met, if you give away a qualifying business asset, potentially that is 100% exempt from inheritance tax. Now they're talking about taking that away unless the shareholder, I think it said, has a controlling interest in the company. So that might sort of have a big impact on succession planning for a lot of our clients if they were expecting BPR to be available in the future. So again, it's obviously all speculation. It might actually happen, but it's that could have quite a big impact on sort of family businesses and any future successions.
Things to think about. Yeah.
Again, so it's something to think about, and there is certain planning and certain structures probably that could deal with any problems that come up. And again, it's going to be a bit of a cliche in this catch up, Chris, but the key is to talk to your advisor, really.
Get in touch with you.
It's all give me a ring. Because it's sort of,
Rishi's not.
He doesn't return my call, so I've got loads of free time.
It's because you didn't work at Goldman Sachs, that's why.
But yeah, I mean, the reason we're saying this is because everything is so specific to people's circumstances. With tax planning generally, there's no one size fits all necessarily. So that's why it's always important to speak to your advisor, really.
That's the danger of the DIY tax, isn't it? That people read something, think it applies to them, try and implement it, and then bang, you're into all sorts of complications and potential problems.
Yeah.
Okay, so that's kind of IHT that we think might happen.
Yeah, that could happen, and yeah, I mean, like I say, it'll be interesting enough enough if things do change, because there's not been an awful lot of change in the last few years anyway on that. So
it's due for some sort of change, reform.
Probably, yeah. It's felt to me. To me, it's felt like probably the last couple of years it's been due a bit, some sort of reform. So yeah, that could change. And again, it kind of ties in a bit with the CGT point as well, I suppose.
I was very surprised that the bands hadn't adjusted with inflation or been adjusted.
Given
inflation.
Exactly,
but
yeah.
Okay. So, that's IHT. What's next, Tom? What next might Rishi be cooking up?
SDLT is another one that I think potentially could
Stamp duty, land tax, yeah?
Yeah, exactly, yes.
Yeah, I'm learning.
So as people might be aware, there was a temporary reduction in SDLT as part of the coronavirus measures. Obviously, the sort of the rationale behind it being to try and sort of keep the property market buoyant, if you like, given all the lockdowns and that kind of thing.
When's it due to finish, Tom?
It's due to finish on the 31st of March, I believe. So
end of March.
You would need to obviously complete on your purchase by the 31st of March to benefit from the temporary reduction.
That's why all the lawyers and estate agents are so busy right now.
Yeah, exactly. Yeah, and actually, there was I was watching the news this morning actually, and they were talking about this becoming actually quite topical because of the most recent lockdown. Again, there's been delays on property transactions in terms of getting stuff through, and as a result, there'll be certain people that were expecting to benefit from the reduced SDLT that might now struggle because they won't be able to complete within the time frame.
Get their transactions, property transactions through. Yeah,
exactly.
It's a notoriously slow process in the UK, isn't it?
Yeah. Which could make quite a big impact in terms of their obviously their costs and whether they can actually
how much tax they have to pay.
Which actually could be potentially depending on sort of figures involved could be a sort of make or break on the transaction full stop really.
Given that was sort of created, I guess, a while back, and he couldn't foresee that we'd now be in lockdown 3.0.
Yeah.
Do you think he's going to extend it potentially?
Well, I think so. I mean, I kind of had thoughts that potentially he'd look to do that anyway. Because again, it's quite a sort of attractive thing that they've already brought in. I think it was back in 2017, a reduction in SDLT for first-time buyers up to up to a value of 500,000, I think it is on a home. So they kind of already brought in something similar. To again to try and get people on the property ladder and that sort of thing. So something like this probably, obviously this is extending to other people, not just first time buyers. It's quite an attractive thing to kind of give people, and given the current lockdown and the fact that, as we've just said, property transactions are taking longer, I'd be very surprised if that isn't extended at least.
Okay. So fingers crossed for anyone who's in the process of all the questions and answers with lawyers, property transactions and all of that. Fingers crossed he extends it for a few months, maybe. Yeah. Who knows? Another quarter perhaps. Who knows? We don't know. Okay. So that's SDLT, Tom.
SDLT.
Anything else to add on there? What next?
What's
Rishi pulling out? What's he pulling out the box next?
So there's I've seen some stuff going around on corporation tax suggesting
that's a biggie.
It's a treat. I mean, our rates of corporation tax are fairly low. I mean, currently they're 19%.
19%. Yeah. Can I just stop you there? You can find out all about corporation tax in the UK on the Wellers blog. So be sure to look that up to understand not just all about it and how it works and who it applies to, but also some of the reliefs, all the reliefs, I should say, available to give you an understanding. Go on, Tom. Sorry about that.
That's all right, Chris. No problem at all. So, yeah, I mean, currently rates are fairly low in the UK. So we've got a rate of 19% currently. Now, an article I saw suggested that there were talks of that being increased to 24%, which is quite an increase. I mean, it was 24% not that long ago, to be honest, but it's I think it was back at sort of maybe back in 2012, I want to say, so that sort of time, perhaps 2012, 2013. I think it's about 24% before, obviously, it then got brought down gradually.
So Tom, they were at one stage pledging to decrease it down to about, was it 17% at one time? They were going to bring it down.
Yeah, I think it was due to come down to 17%, obviously before things got unwound. I've got.
And wasn't it the last budget they reversed that, said no, we're not.
Yeah,
we're not
they
committed to that
removed
anymore.
it, so it stayed at 19%.
And now we're looking like it might go.
There's talk about it going back up. Now, this one it's a tricky one. I struggle to see how, at the moment, that's going to go through straight. Certainly not straight away. Twofold, really. But
go through Parliament, or go through in terms of when it goes through.
I mean, get approval. I think it'd be a struggle for Rishi to push this one through. Personally, I think. I mean, twofold. We've obviously Brexit's kind of been sort of dealt with, I suppose. We kind of have a bit more of an idea as to where we are with that.
Kind of.
So that obviously creates. It takes away some uncertainty, but obviously it does create a few sort of humps in the road, I suppose, for some companies. So to suddenly be putting corporation tax up when there are certain considerations as to where people should be based, I think that's a difficult one to possibly put through at the moment. But also the fact that, again, going back to coronavirus, a lot of companies have been hit pretty hard through this, as we spoke about earlier on.
Are they making any money?
Yeah. I mean, they're not making any money. So arguably, if companies are in a loss-making position anyway, it won't make a difference, because if you're loss-making for corporation tax purposes, whether the rate's 19% or 24%, you're still not going to pay any tax, really.
Because you're not making money.
Yeah. So I think it'll be a difficult one to put that one through, and even for those companies, obviously, that have done well, certain companies have done well over the last year. I think it would be difficult to put a sort of big tax burden on them when obviously people have kind of been trying to keep their head above water mainly for last year. So there's talk of it that could happen, but I think he'd struggle to do that this time round, personally.
It's always been a controversial area, hasn't it? Because I remember a few years ago there was a huge amount about how some of the big corporations, the Amazons and the like, the tricks they employ to circumnavigate corporation tax.
Yeah.
And there was, the Conservative government, and I know there have been different iterations of late, we've had a few elections over the years, that there was a big emphasis at one time that they were committed to reducing corporation tax to get more investment, more business into the UK. So this may be a reversal of that. Do you think you're saying that you don't think he can get it through Parliament. So if he says there's going to be an increase to 24%, your feeling is that he'd struggle to get that through Parliament. So he'd be facing like the equivalent of George Osborne's pasty tax.
Okay, well, potentially. I struggle to see how it would be sort of acceptable for all, for obviously all the MPs and by definition the electorate generally to kind of be putting a lot of, a lot more pressure on businesses really. Given what's happened last year and that sort of thing. So could be wrong, as we said before. It's all speculation, but at the moment I think that'd be a tough one to kind of justify and get through. Yeah. Okay.
So that's corporation tax.
Yeah.
Next up, Tom. What levers is he altering next?
So I think there's been some talk of looking at dividends as well. I mean, it feels like we're going through all the taxes here, Chris, but there is
corporation tax and a dividend tax.
Oh. Yeah. So now dividends are at the moment at sort of taxed at a lower rate than just your normal
income tax.
Yeah, exactly.
But it's because the willingness to take on risk to open a business.
Exactly. Yeah.
And all the stress and risk that comes with, right?
Yeah.
That's
exactly.
Right. Yeah. That's the thinking behind it. Yeah.
Yeah. Exactly. Yeah. So there is a bit of rationale behind it.
Entrepreneurial.
Yeah. Now I think it's been a focus sort of in recent years to try and align tax rates between for people that are employed and also self-employed. I think which is why they started looking at national insurance a few years back. So there's talk of sort of dividend tax possibly now being subject to NIC, apparently. Now, how exactly that would work, I'm not sure. Whether it'd be a new class of national insurance, I don't know. But there is talk of sort of subjecting dividends to national insurance, which would kind of be in keeping with trying to align those that are self-employed. So when we talk about people that are self-employed, where people sort of operate through a company, the standard model, if you like, is to take a sort of low salary and top up with dividends. So most of your income comes from dividends. So when we talk
tax
about
efficient,
exactly. But by subjecting dividends to national insurance, it potentially then sort of tries to marry up sort of self-employment with employment, if you like. So it kind of fits in with that.
So the reward for entrepreneurialism is potentially narrowing. To income tax. So being employed.
And I mean, to be honest, that started. I think it was when George Osborne was
2016. We did quite a few posts at the time around planning around that.
So obviously there was the big reforms to sort of how dividends were taxed there, and it was the sort of tax benefit of taking dividends sort of changed quite a lot at that point. So that's kind of the whole sort of beneficial tax status, if that's the right term, of dividends is kind of been happening over the last few years anyway, really, with the dividend allowance when it first came in, when those reforms first happened, was I think it's 5,000 from memory.
Didn't they reduce it then?
Yeah, exactly. Yeah, so currently it's now 2,000. So it's kind of been chipped away at a little bit, I suppose, ever since that reform came in. So
so basically, so we're looking at NIC being potentially applicable. Again, what sort of thing do you need to think about? Potential planning. I say potential because this is all speculation.
Yeah. Again, speaking to your advisor about again, it kind of comes down to timing and to an extent your sort of attitude to risk a little bit.
So timing is to when you take your dividends. When you pay out from the business, basically. Yeah.
But obviously there are other factors to keep in mind as well. So it's not a one size fits all
circumstances again. There you go.
There are things to keep in mind. And there's often a risk that with decisions they're taken purely from a tax perspective, whereas actually there are things to keep in mind as well.
What's the expression? Don't let the tax tail wag the dog.
So, I was trying to think
something like that.
Yeah, exactly.
I might have got that completely wrong.
So it's just a case of having a discussion with your advisor again. Really, is again, without sounding like a broken record, is going to be the sort of main theme here.
Okay, and then next up, Tom.
So we're almost there now. We're getting
wow, he's changing so much.
So there's been talk. I think it was in the news yesterday, or at least this week. I think there's been pressure from. I think it was Tesco actually that sort of lobbied the government to introduce an online sales tax.
Now this is to do with business rates, right? I mean, this is the unfairness of business rates.
Yeah. So my understanding of it, it's that the likes of if you look at the supermarkets, for example, I suppose that's
all their stores.
They've got all the stores. You've got the rent, the all the costs that go with it. But then you've also got retailers that can operate online solely, and actually they haven't got all the costs that go with it. So
warehouses.
So I think that's the rationale for it. And I think the article I was reading was I think Tesco was suggesting a 1% surcharge on corporation tax. Effectively, I think is how it would work for online retailers, effectively, to try and I suppose level the playing field. Now, again, I suppose it's a difficult one as to where you would sort of almost draw the boundaries as to who would be subject to that and who wouldn't. It would probably require a lot of thought if that did come in. And I suppose arguably there's a question as to whether it would be fair in any event, because it just because someone's got a different sort of business model, would you then start subjecting different industries, for example, to different rates of corporate? I'm not sure where you'd stop. So, be an interesting one to see where that one goes. But whether that comes in or not this time, it's topical. But
it's been debated for quite a long time. This has been a topic of conversation. It's been ongoing for quite a few years now, because I mean, the online giants. They've been around and doing very well for a long time. So
yeah,
it surprises me that nothing's been done about it yet. But
yeah.
we shall see, right? We shall see.
It'll be
Well,
interesting.
any others that you're thinking of, Tom?
I think so the last one I wanted to sort of speak about, Chris, that was hospitality, really.
Yeah.
So
hospitality trade, absolute hammering.
Yeah, well, exactly. I think they're the sort of the top sort of industry, I suppose, that people think about when you think about
with travel and tourism. Yeah.
Yeah, when you think of those sort of the
tragic.
Yeah, so certainly the business that have been hit hardest, you'd say probably would be within that sector, right? I suppose. So obviously, to try and help things. Back end of sort of last year in the summer, I think it was. Rishi introduced the temporary reduction to the VAT for the hospitality industry, so it came from 20% down to 5% to sort of try and
Eat Out to Help Out scheme and all that. Well.
Yeah, exactly. That was also introduced as well.
How he got known as Dishy Rishi.
Yeah. So that was also introduced to try and sort of give them a helping hand. I suppose given we're now currently in another lockdown, hopefully, coming out of it within the next whenever it is, few weeks, months, whatever. I'd be surprised if the VAT reduction isn't extended to try and help the hospitality industry get back on their feet when things do hopefully ease off. And similar to that, I suppose, there's a question as to whether the Eat Out to Help Out scheme will be brought back in some sort of form again, just to try and sort of give them a bit of a helping hand to get them back up and running. To try and sort of encourage people out, because I suppose even if lockdown is eased, there might be a bit of uncertainty amongst people about sort of going straight back out, for example. So a scheme like that might help them to get back on their feet. Possibly.
Yeah. I was watching Channel 4 News the other week, and they were talking about a carbon tax potentially on its way. Right. So they weren't sort of saying what form it would take or how it would work, I think, but there's certainly speculation that a carbon tax could be on its way. Maybe not this budget, maybe future ones.
Yeah.
Of course, that could have a massive impact on things like farming, food, drink.
Yeah.
And that would push through the hospitality trade, because those industries in the creation of food and drink in particular, so carbon intensive. So then they'd pass on those potential price increases to the end user being hospitality trade and the consumer.
Yeah, I mean, again, I suppose we've sort of how much more focus there is now on sort of climate change and sustainability and that kind of thing. It's difficult to see that can't that wouldn't be brought in.
Inevitable, doesn't it?
Yeah,
seems inevitable.
It's such a sort of hot topic, I suppose, at the moment, that some sort of tax to I suppose the incentive being to try and reduce your carbon emissions, right?
Yeah.
Sure, that sounds logical.
Well, it's this thing that we almost started on, isn't it? Of how tax and the use of taxation historically has, and in the future obviously will continue to alter behaviour. It has a massive impact on behaviour.
Yeah.
I think the carbon tax, in whatever form it may eventually take, will be, as you say, inevitable given the push to go green. And I think the government have all sorts of various carbon emission targets for 2030 that we've got to reach.
It would make sense, wouldn't it?
I don't think Greta's impressed with them though. She wants it sooner, like tomorrow. Greta Thunberg.
Yeah.
So, I mean, does that cover everything, Tom, do you think?
I think so, pretty much. Yeah, I mean, there was talk of a wealth tax being brought in, but I mean, I don't want to go into too much detail, because I think Rishi came out and has effectively ruled that out. But effectively,
CGT is a bit of a wealth tax, isn't it? So an inheritance tax as well. So
yeah. I mean, the wealth tax was like a standalone one based on, I think it was going to be based on the value of your overall assets above. I think it's subject to over 500,000 or something.
It's over 500,000, wasn't it?
Yeah.
There were also there were rumours that council tax could eventually be done away with, and there'd be some sort of property tax instead.
Oh yeah, I was reading about that the other day, actually. Yeah.
I don't know if that's true, but the issue that then raised was that you have some people who are quite sort of, how can you put it, asset rich but cash poor. So they've been in a living, particularly pensioners maybe, living in an area that's really come up in terms of property prices, but if they're over 65 and living on a pension, then they might not have a huge amount of income. So if they're then being taxed on the value of their property, which could be $750,000, $1 million, you know, if it's somewhere in, I don't know, Knightsbridge or Chelsea or somewhere in London.
Yeah.
Probably a lot more than that, actually. then that could be a huge undertaking for them. So I don't know.
I think that was one of the sort of main issues with this wealth tax that was being discussed. You know, exactly that, is that potentially people be subject to it even though they haven't got any liquid assets. So, you know, where would they find the funds to pay
it would have to be balanced between your income, your wealth, and your property. Yeah, I mean, it could get very complicated very, very quickly.
Yeah, I mean,
like most of the tax code.
yeah. I mean, interestingly, on the wealth tax, I was reading that I think some sort of academics who come up with some of these reports were suggesting that if it was brought in, albeit it sounds as though Rishi's kind of almost definitely ruled that out, it could raise 260 billion in revenue. Yeah, we're talking a massive amount.
Do you say 260 billion?
260 was a figure I saw.
Really?
In one
so
particular
article, he must be looking at that then, or he must be thinking about it, whether it comes in now or a future budget, because
possibly.
Go back, you know, to earlier in this conversation, I was saying the budget deficit stands at about, so the difference between the overhang in terms of how much more we spend than the government take in taxes, that's 271 billion. So
it almost solved that problem.
Some reforms there could really sort of grab a grab there, a tax grab there could really start helping to solve that issue.
Yeah. I mean, I think that I mean, there's obviously a lot of other factors as to whether,
of course,
people that might be subject to it, for example, could sort of leave the country quite frankly. They could choose to do that, in which case it's going to have a massive impact, isn't it? So
and first and foremost, these have to be voted through Parliament. I don't think it's unfair to say that there are a lot of Conservative backbenchers who probably favour a low tax post-Brexit Britain. And that he's going to have to tread quite carefully to get some of these things through. A lot of them have constituents who are either maybe being made unemployed or business owners who are really struggling. So there's a lot of sensitivity around this, isn't there? Huge amount of sensitivity around that. I'll just add to, I think we're sort of there, aren't we, in terms of what he might change?
Right? Pretty much. I mean, these are thoughts based on stuff that I've read and sort of seen about there. So
we speculated, didn't we?
I think that's the key thing here, is to sort of keep in mind that it is all speculation. We haven't got a crystal ball, so who knows what happened, quite frankly.
We're trying with our crystal ball. We're giving it a good go, Tom. we should take bets. We should put some odds on what we think is going to go. Maybe we'll do that on a blog or something.
we could pull together our sort of list of things and do a bit of a sweepstake in the office, perhaps.
We could also sort of compare this list versus what he actually does change after the budget.
Yeah, that's right.
See how good that crystal ball is of yours, Tom.
That's it.
So okay, so I can start bringing it to a close. I mean, something interesting that came out I read the other day is that apparently the tax burden is currently, without any of these potential changes in. So currently the tax burden is at its highest since the 1950s. I think it's Clement Attlee's government. That was post-war.
Yeah.
So that sort of shows you where it's at. Historically, it's at a high already, and he's already talking about raising more taxes, and especially as we're not necessarily recovering from the pandemic, economically speaking. So there's that. I also sort of read a book quite a while ago called Daylight Robbery by a guy called Dominic Frisby, and it's you'd never read this book. You look at what this book is about and you go, I'd never read that book. I'd just never read it. But Dominic Frisby he's a financial writer and a comedian. Very unusual pairing there. So he's both. And he decided to look at tax and the history of tax. And then he sort of finishes off with how he personally would go about reforming some of our tax system here in the UK. And he, funnily enough, cites Hong Kong and places like Singapore as examples, certain elements that we can follow. But he also covers certain things that a lot of wars and a lot of revolts have historically been around tax. So some examples include the peasants' revolt here in the UK, That was one over tax, and he actually goes into detail. It's quite a good yarn as to what goes on there and what happens to the revolters in terms of how the king treats them. As you can imagine, it not well. Good old beheading and all that.
Yeah.
He also interestingly cites the American Civil War. Okay, and what he was saying is that actually started less so over slavery and more so over an import tax on agricultural products, which meant that the South was forced to buy less good agricultural products from the North, and the South got annoyed about this, costing them more, and hey ho.
Yeah.
It all kicked off. And more recently, and for those of you who are alive and remember it well, I remember it well as a 10-year-old, there was Maggie Thatcher's poll tax, which created a right uproar. So there's a lesson potentially here, is that, you know, you can get away with taxing so much, but be careful, because history is not kind to those on the wrong side of the tax argument. I think on that bombshell, Tom, I think that's a good place to leave it. And I'll just say thank you so much once again for doing that. All that research takes time, and I think you explained that brilliantly, and gave us all something to think about and keep us awake at night.
Well, that's what I'm here for, Chris.
Yes, exactly. And I'll just stress once again, this is speculation. You know, be sure to talk to your advisor, especially Tom Biggs, about planning, etc. Okay, Tom, fantastic stuff. Thank you very much.
Cheers, and Chris.